CASA ratio also improved. In fact, they outgrew the industry as far as, the advances as well as retail loans are concerned. The wholesale retail mix also seems to be changing. So I think on core performance looks steady. They are diversifying from just being a South-based, Kerala-based bank to broader branches. There's some bit of a union issue, which I think will gradually get sorted as they diversify more pan-India. But this is extremely positive, Nigel. More so, I think this is a change in stance of RBI in allowing, large foreign players to own sizable stakes in the bank. And this is almost like banking sector reforms reloading. This gives access to, cheaper capital, global markets, and host of good practices, I think. And then India obviously has officially taken a stance that we want some of our top banks and top 10 banks globally. I think you will see more banking reforms getting loaded on this.
Yeah, I mean, so many foreign entrants now coming through. Emirates NBD with RBL, Mitsubishi, financial group with Yes Bank, and there's some chatter around Shriram Finance as well. So let's see. But Gurmeet, just wondering, and of course, we're going to try and get more clarity from the Federal Bank management. So they get 6,200 crores of additional capital. The bank was already very well capitalized. And when we spoke to them immediately after the earnings call, they did not lay out any specific plans in terms of inorganic growth on wealth management. I remember we asked them this. So, I mean, right now it's like anyone's guess. What's your best guess? What will Federal use the money for?
So, Sudhi, I think one is obviously they are well capitalized, but I think the way growth is picking up, especially the changes done on the corporate loan side, removing caps of 10,000 crore on corporate loan limits, allowing banks to do acquisition finance. I think not only just capital, I think the name, the expertise, some of these large players bring is extremely important, more from an investment banking point of view as well. So that's important. Second, as I said, a lot of these banks will get re-rated because RBL has had its share of issues with credit card and microfinance portfolio. Federal Bank also has been trading around book value for a very long time. And I think there's a lot of catch-up which will happen in some of these tier 2 banks. They have large presence, and it gives, as I said, access to the cost of funds has an impact. You get a name, once you have larger names joining, you join a bigger consortium when it comes to large deals. So there are multiple implications. And more importantly, I think RBI has decided post Yes Bank and other episodes that once the banks are doing well, they would want larger, stronger hands to come rather than RBI keep intervening with on a daily management issue. So broadly, as I said, you might also see Indian corporates now lobbying for increased stakes in banks. Currently, the voting rights are capped. I also think the automatic approval is 5. With RBI approval, you have 9.9% stake as the highest, as well as individual investor is concerned. That might get a relook. So to me, this is broader banking reforms, as I said, getting reloaded.
Okay. All right, Gurmeet, we'll leave it there. Thanks very much for a quick comment and a quick chat there. So there you see the news finally coming through. Federal Bank gets a new investor. Blackstone is going to be checking in with a stake which is going to be just under 10%, and this is going to be happening via an issue of warrants. And in this entire transaction, Federal Bank gets in capital infusion to the extent of almost 6,200 crore rupees, just 1 or 2 crores less than that, rounding off the figures over there. But anyway, let's go back and look at the rest of the open session as well. So it's still a little quiet, it's still a little cautious. Nifty is down about 40 points at the open, and let's see where the drag is coming in. Lever is falling more. Lever is down about 3% right now. Cipla is not showing any excitement after that tie-up with Eli Lilly, 3% down over there as well. Dr. Reddy's, which reports numbers today, is down about 1%. What else? Eternal is still falling after its 3% cut yesterday. It's down about 0.5%. Actually, all of consumer is lower, actually. Tata Consumer, Titan, Eternal, Lever. Most of these stocks on the downside, Nigel.
Well, that's right. Just keep an eye out on a couple of these other names. Rubed highlighted the aluminium stocks will be in focus today, and that seems to be the trend that's playing out. So Hindalco, because it's a dual benefit. India operations gain because of the aluminium prices moving up here. And the Novelis operations gain because the Midwest premiums have moved up. And as appeared, that's Alcoa says, that the Midwest premium is enough to take care of the negative impact of the tariffs. So because of that, both those two are higher. And Vedanta, the highest amount of the share price value comes in from the aluminium business. So that one as well is up. Aluminium doing very, very well in today's trading session. From the broader markets, though, Colgate, that's the one that's getting wrapped on the knuckles. As Manglam said, The numbers that were expected were, expectations were down. Stock has been an underperformer. But till growth comes back, there's no reason to buy the stock. It's trading at around 40 times, even after correcting close to around 40% from the peak. So that stock is under pressure. The OMCs have come in for some selling. Crude oil prices have moved up a little bit. HBCL, I think, was down close to around 2%. You had BPCL as well as IOC. All those three stocks trading in the red. Saman Capital, that's the other one that I highlighted in my morning chat. It comes out of the F&O ban. So normally you see a good amount of interest out there. That's one of the big winners. It's up close to around 3% as we speak. Sagar Cement at the bottom of your screen. Well, that one's opened up in the green. Remember, volume growth is something that was good. That was close to around 17% volume growth. But profitability still needs to come about. So valuations give it comfort. So that's why below that, 230, 240 odd mark, you normally see the stock see some buying interest. But the numbers were a little bit disappointing. We'll try to get the management and get further clarity on that front as well. So Surabhi, a negative start. We're down 30 points thereabouts. So from yesterday's high, we're down close to around 225 points or thereabouts.
Okay, so some profit taking at these higher levels. Let's welcome in our next guest then. Gautam Shah, founder of Goldilocks Global Research, is with us now. Gautam, thank you so much for joining in. Hope you had a cracker of a Diwali. Season's greetings to you. The market actually had a pretty good Diwali as well. But the question is back, now what? Now that we're almost at the doorsteps of the previous all-time high. I know in our past conversations, you've sounded really optimistic. But what do you make of the overall setup at the moment?
Good morning, Surabhi. I don't think many people would have thought that by the end of October, we'll be close to lifetime highs, and that's what markets can do. And I think the real test of the market is always how it reacts to difficult news flow. And I think in the last couple of months, we had a lot of difficult news flow locally and globally, but the market kept respecting support levels. I think the point that I mentioned in my last interaction. And now as we speak, this move of the last 1 week, I think just has too much ammunition on the charts and tells me that this is genuine. We have indeed seen a sort of a breakout. The news flow has got supportive. The breadth is getting better. The top 100 has done a lot better. We have banks, IT, Reliance, all trying to come back at the same time. So yesterday, I think morning was slightly overly celebrated, I would say, and therefore we've seen some profit taking, but I think this is just temporary. All dips should get bought into, and I think the markets are headed for new lifetime highs and beyond. On the Nifty, I think 26,700 is our next stopover number just for the near term. But from a medium-term perspective, we stay positioned for levels of 27,500. So I think one should just ride this move. Do not overanalyze. I think the news flow is getting better. The charts are already very, very good. And I think the risk reward to enter longs, even at current levels, I think is quite lucrative.
Okay, good to see you in, Gautam. You're sounding a little bit bullish, so that's good news. And you have been saying, right, when the market chooses to look past bad news, that's the first signal that, it wants to climb the wall of worry. A couple of questions here. 27,500, I think that's the target that you have ultimately on the Nifty. What's the timeline for this target? And when does this bullish bias get negated? On the downside, what's the level you would not like to see breaking first on the Nifty?
See, a couple of points. We are coming out of a period of no return for over a year. And in this period, obviously, the government and the RBI has done a lot to propel the Indian markets and the economy higher, which I think was a very strong foundation that was laid. And secondly, in the last 3 months, we've really behaved like a pendulum, oscillating within a large band. So keeping that in mind, 25,300, 25,400 now becomes a very important support. Till this level stays, I want to believe that the market is headed higher. And we will make a sequence of higher tops and higher bottoms. When you are near lifetime highs, you don't want to focus too much on targets. You just want to focus on supports. But I do believe that between now and say January, we could be getting closer and closer to that 27,500 number. But let's not forget, in these last 10 days, it's just the top 100 that has done well. The small cap index has been absolutely flat. Mid caps have actually underperformed. So I'm batting for the comeback of broader markets in the next 1 week. And if that happens, people will start feeling the strength in their portfolios, which is currently actually not the case.
All right, that's the important part, Gautam, because yesterday, after all the euphoria and all that excitement over the last few days, people were saying, markets are going on saying it's going to fresh all-time highs, and my portfolio is not feeling like that. So it'll be good to see broader market participation, because when the broader market participates, that's what makes your portfolio feel good. Tell us if you have any kind of levels on the mid as well as the small cap indices, and if you want to throw in a couple of stocks as well.
See, the mid-cap index, as we speak, is flirting with that level of 60,000, which has been a problem level for the last 6 months. And I think once that level of 60,000 is cleared, I wouldn't be surprised if you see a 3,500 point move there. So I think that would be special as and when it happens. And I think we've done a lot of hard work around this level of 60,000. On the small cap index, I think 18,200, I think is the critical number. Once that is taken out, I'm looking at a move towards a level of 20,000, which is near the previous high or near lifetime highs. So sustenance above 18,200 on the small cap index, I think is something that should lead to greater strength. But the last 10 days, everybody is speaking about FI selling and the long short position that they have been keeping for a while now. With top 100 making such a strong comeback, with IT making a comeback, with banks doing so well, I just get the feel that now domestic money and some foreign support could actually propel the market higher from here.
Okay, so that's on some of the leadership sectors. So where should one be, within financials, Gautam? That's the question. There's so much happening. There's so many deals happening. I mean, we just saw the federal deal get announced this morning. So there's a lot of news and a lot of noise as well within the financial space. What looks good?
Well, honestly, we like everything. I think one can just buy the basket, one can buy the ETF. I think valuations are comfortable, charts are excellent, relative strength is immense. And I think banking has been single-handedly responsible for the kind of strength the markets have seen in the last 10 days. So I think our working target for the Bank Nifty has been about 60,000. We've been maintaining it for over a year now. I think we will get there soon. And I think we will even get past it. Because when I look at the placement of some of the top banking stocks, including the NBFCs, and some of the top NBFCs have been our favorite for a very long period of time, I think you're going to see a lot more strength. But I think the key space within banking and financial services, which I think is going to be the key highlight, is PSU banks. I think I like the top 3 or 4 PSU banks, and I think they're going to register stellar returns over the next 6 to 12 months.
All right, Gautam, let's take a break from the equity markets. What's the view on gold? Gold and silver. All that glitters in the last year was gold and silver. What are the charts telling you on both those two?
Well, we've been advising aggressive profit booking over the last 1 week. I think for the last 1.5 years, I think we've been very, very bullish on both of them. Pretty much spoke about it in every interaction of ours. But in the last 7 days, we felt that they had come to a point where the rise was parabolic. And we felt that a lot of the positives are in the price. And we also did see a lot of madness on the screen and on the charts. So I think they're going to take a bit of a cool off, maybe correct by about 10, 12, 15%, which is quite normal in the overall scheme of things. So for the time being, I think the gold and silver rally is done with. Probably even the Bitcoin rally is done with, because there are some indications of topping out. And I think the focus is going to go back into equities. So I think equities is where the bigger opportunity could be over the next 6 to 12 months. But don't get me wrong, I remain positive on gold and silver if somebody is taking a 3-year view. But if you're taking a 3 to 6 month view, these might not be good levels to add.
Okay. So we were talking about the engines that will turbocharge this market higher. One is financials. You're pretty convinced there. What else, Gautam? What else looks good?
Well, I generally don't change my sector preferences, and I think my sector preference is still metals. I think I really like the way the entire basket is shaping up. Today, you are seeing what's happened to aluminum. We've seen what happened to copper in the recent past. I think some of these charts are incredible. Valuations are very comfortable for many of these companies. I think they're under-owned. People are still not being able to make a case fundamentally. And given the positive talk with the US, I think there is a feeling that there could be a very large trend in metals on an overall basis. I mean, top metal stocks could appreciate 20-25% in a matter of 6 months is what I feel. And I think we've already kickstarted that. So metals is one space that we like. Auto we like, power and infra we like, the entire PSU bank and the entire PSE space we like, and financials we like. So these are the 5 or 6 buckets where I think capital should be committed into.
All right. Anything that's not looking good?
Well, there are too many stocks and too many sectors that have not performed in the recent past. And I think this is a market where you should ignore stocks that don't move with the Nifty. For me, in my book, FMCG, IT and pharma are still an avoid. I don't see any trend there, and I think one should just stay away.
Okay, all right. And, you briefly mentioned about Reliance Industries. Now, that's like an index by itself, right? When the big boy does well, the Nifty has got legs then to move up. So Reliance Industries, after that brief correction, it seems to be coming back into form. What are the levels you're seeking on that one?
Well, I don't have a specific view, and I do believe that the energy space, including Reliance, is going to continue to underperform. The fact that it's not falling itself is a very positive sign. I think it's going to be in a band of about 200 rupees, maybe 1400 downside, 1600 upside. But because it's such a big heavyweight, if it doesn't fall, that itself helps the Nifty. And now with IT making a comeback and banks looking good and capital goods, stocks like L&T making a comeback, I believe that's very, very favorable for the overall market.
Okay. All right, got that. By the way, I just want to point out that there's a lot of pressure on lever this morning. Not that there are any major downgrades or any big sell calls, not that I could spot one. But I think the market's just pricing in the reality that the company is going to be squarely focused on volume growth now, not so much on price. And that's what the new CEO outlined very, very clearly in the interaction post the results release yesterday. So that one's under very clear pressure.
Well, and the market believes that the deal coming, Surabhi, because the barometer normally is this Gokuldas exports, the stock. Yesterday, the stock was buzzing up. Today, in the first few minutes of trade itself, they're bidding the stock up. So hopefully the deal does come about, but that's normally been the barometer. When you get the positive sound bites coming in from Mr. Trump, then you have the stock that's up. And when he says, he's not impressed, etc., all that, sort of commentary that comes in, then the stock is under pressure. So for today, it appears that the market believes that we are closer to the deal. Let's hope that they're right, because the stock has been bid up considerably as well. Gautam, one worry, which hasn't been a worry of late, has been crude. Crude has been very, very well behaved. And you're mentioning that, the energy basket itself, maybe it underperforms a little bit. What's your view on crude oil prices? Even when geopolitical tensions come up, it couldn't get past even $75 a barrel. And that too, it held there just for a couple of days. Your view on Brent?
Typically economists start worrying about crude when it goes up too much or it goes down too much. I think that's really the debate that keeps coming in. But I think 55 to 75 on the NYMEX crude is pretty much the range. I'm very clear that it is in a downward bias. It will remain under pressure. If 55 levels were to get broken on NYMEX crude, then I think we are looking at some sort of a concern. But I think it's right now it's in a space where you don't look at it too much, and I don't think it's going to impact equity markets. So as I said, only below 55 or above 75, would there be a concern or would there be any correlation with equity markets?
Okay, so as of now, not much of a concern. Gautam, what about global markets? Do you see anything different, anything changing? There's so many times that people have questioned this AI trade, but it continues to be as strong as ever. And how do you see the correlation playing between the US market and the India market? Because the former has outperformed in a big way in the last 12 months.
Well, I think the AI trade is here to stay. I think it's changing and disrupting our lives as we speak. And I don't think the markets have discounted it completely. But the sad part is US and China are pretty much two countries or economies which are right at the forefront of the AI trade. And I think India is way behind in that particular trade. And that's probably the reason Indian markets have not done as well. So US and China, we continue to be positive. US, I think, is looking slightly toppish in terms of large caps. So it might take a bit of a breather. But the overall global landscape for equity markets continues to be positive. But I've been maintaining this for the last 6 months. I think the next big trade, after gold and silver, is really China and Hong Kong. So I do believe that those two markets will do exceedingly well over the next 6 to 12 months and could beat every single equity market over the next, many quarters. India will do well, but it will find it very difficult, to beat returns of other markets in the world. And that's probably the reason you need to be in the small caps and mid caps for outperforming.
Always a pleasure speaking to you, Gautam. Wishing you a good day ahead, and we look forward to chatting up with you. You made some very, very relevant points, and you're sounding very optimistic on the markets as well. So happy Friday to you. We'll chat with you rather soon.
Thank you, Ranjan. See you.
Well, let's focus on the metals pack then. And aluminium stocks, well, they are surging in today's trading session. And there are two big factors that play out. One is LME aluminium prices. They've reached the $2,850 per ton mark, which is the highest we've seen in the last 52 weeks. So LME aluminium prices is at a 52-week high. When LME prices move up, then you keep an eye out on Hindalco for their India operations, NALCO because they have an element of aluminium sales. They also have alumina in there. And Vedanta because most of their share price value comes in from aluminium segment. The reason that aluminium prices itself have moved up is because demand-supply dynamics are playing out in favor out there. And there's a smelter in Iceland that has been put out of supply in the near term. That's on a temporary basis. The rough capacity there was around 100,000 tons. Now, lower than expected supply and good demand is what is propelling pricing to move up. Also, the Fed is expected to cut rates later this month. So global monetary easing is also supporting its cause. And besides that, inventory levels have moved up. So all that explains why LME aluminum prices have moved up. But Alcoa was up more than 10% overnight. And one comment that came in from the CEO was very, very positive. He said that the current prices as well as the Midwest premium fully cover for the tariff impact. Now, this is a positive read-through for Hindalco because Novelis has exposure out there. And remember, the Midwest premium has moved from around $500 per ton. It's moved to more than $1,500 per ton. So the negative impact of tariffs seems to be getting nullified. And because of that, Novelis, their profitability may not get as hit as what was thought earlier. So aluminum stocks doing well, LME prices moving up, and for Novelis, a positive read-through coming in from Alcoa. So that's why those are the stocks of the morning, as we pointed out earlier today.
Shining bright, all the metals out there, the best performing sector of the day. Otherwise, the market continues to be fairly range bound, 27 points lower on the Nifty overall. Mid-cap index is doing better today with a gain of about 0.3%. That's the Nifty for you. Mid-caps are looking better. And the advanced decline ratio is fairly even-steven, at actually so early in the morning at least. But the sector spotlight now shifts to IT. Yesterday, at least, the IT space was a big winner. We have Moshe Khatri, Managing Director, FinTech and Tech-Enabled Services Investment Banking at Wedbush Securities with us. We also have Ganesh Natarajan, Chairman of GTD Data Solutions, joining in. Gentlemen, great to have both of you, here with us. I think the market yesterday was taking note of the fact that there is some softness around this visa issue, and I think the clarifications are helping that this $100 fee is not going to apply, say, to student visas. It will not apply if you are changing your employer in the US or if you are renewing your existing H-1B visa. So those clarifications help to an extent. But the issue goes beyond that, perhaps. So, Moshe, if I could start with you, I mean, the issue is really about growth and whether large Indian IT services companies can really pivot in an era where, it's just hyper affinity for all things AI. How do you sum up the commentary that you've heard from the Indian companies so far and, how they will navigate the whole growth question?
Yeah, growth has been impacted by multiple factors, anywhere from the disruptive impact of Gen AI, the lack of funding for discretionary work, some competition that we're seeing from GCCs. So collectively, it's been pretty difficult. I just want to say one sentence regarding the H-1B visa program. Look, in general, the industry has been battle tested here. And a lot of those large companies have built a pretty scalable delivery, facilities or operations out of the US. So in our view, they'll be able to navigate through that. Obviously it's not 100%, but I think they're well positioned to get there. Growth is going to be challenging, at least for now. And I think the bigger issue is more about how do you position yourself to benefit from this Gen AI spending cycle. And there's a spending cycle, believe it or not. The question here is, does it impact the business? Does it cannibalize revenues, especially with some of the low-end work that gets done? I think that the verdict is yet to be made in terms of how does it impact actually the industry in general.
But what's your reading of exactly that, Moshe? I mean, a lot of Indian companies are talking about launching AI modules. Many are talking about changing the workflow systems as well internally and getting AI ready. How do you sum up some of these efforts?
I think the sector is very well embedded here. But again, the real question here is, when do you get these projects to scale? That's really the main question, and that's going to drive growth down the road. And no one really has a good answer for that. That's why we're kind of in a transitional period right now.
All right, Moshe, one more question with regard to Infosys. The promoters, they said that they're not going to be participating in the buyback. It could very well be because it's not tax efficient. But the street read it very, very positively and bid up the stock. What's your view?
Well, look, I think Infosys as a company is doing what it's supposed to do. They have two buckets of growth. one that focuses on cost cutting and running the business for their clients. That part of the business is actually growing. And then they're also repositioning the business to focus on Gen AI. So, I think management is doing exactly what it's supposed to do as we speak. And it's getting you some growth even. So it's not a bad thing.
So positive on Infosys from here on?
Yep.
All right, let's welcome Mr. Natarajan as well into the discussion. Hi, Mr. Natarajan. Good morning and good to see you win. How are you reading things with regard to the Indian companies? They seem to be turning their attention a little bit more to the AI front. How big is the opportunity and how do you think this pivot is taking place?
I think we're entering a new normal. And the discussion in the last 3 months obviously has been on the H1Bs, etc. And hopefully, if we're entering an era of stability, I think the only category of people who need to worry are people who have maybe done their engineering in India, worked for a year, and for them, the $100,000 thing will be punitive. But apart from that, as you said, graduates, people switching from L1 to whatever. So I think all those categories are safe. Now, in that context, let's look at the market. I personally believe that in the next 2 years, you will see another big wave of growth. And that's primarily because people are moving from experimenting with point AI solutions, with Gen AI, et cetera, to much more of game-changing AI. Now, when I say game-changing AI, you are really looking at a situation where somebody will take maybe a logistics process and completely reimagine it, saying that, look, what are the AI touch points? How do I optimize the process and re-engineer it to make sure that we really get maximum advantage out of it? Now, in this context, I think the opportunity, like we saw maybe 20 years ago with Y2K, where there were these huge projects coming through, I begin to see that happen. So I think the game-changing AI, which could be multi-million-dollar projects, is one. The second, of course, you heard the TCS commentary on investing heavily in data centers. So helping our clients to really access LLMs, building small and narrow language models for enabling them to harness agentic AI, I think the canvas is really expanding. So I'm bullish. I agree with Moshe that, you can't expect any miracles in the next few quarters. But I think over the next year and a half, you'll see significant growth coming back to the industry.
That's good to hear, Mr. Natarajan. Morning, sir. And Infosys also spoke about this, right? They're deploying some 2,500 Gen AI projects and I think 200 agentic AI. They kind of singled out some of these numbers in these projects in their call. But if we take that longer term horizon, say over the next year and a half, as some of these projects come to fruition, what are we talking about? Can some of the larger companies get back to at least high single-digit growth, if not double-digit growth?
I'm expecting, say, double-digit growth. If not in this financial year, but if you look at FY27, I think you'll begin to see companies, especially those who are nimble, who are really focused on not just generative AI, but building agentic software for large horizontal applications. I think those will go back to the 10-12% growth. I don't see any doubt about that. People who are not still kind of putting their toe in the water and not jumping in and really doing or really winning large projects, they might still be struggling at the single digit. But I don't see the industry being at single digit for a very long time.
That's good to hear. That's very good to hear. And Mr. Natarajan, what will this margin, what will this transition over the next year and a half mean for margins? Some argue that the deployment of AI is going to be margin dilutive because it's all about saving costs, and then client will want those savings to be passed on.
Well, that is true, but look at it this way. One is what you're saying, which is that clients will say that, look, you yourself are going to use AI and programmers will no longer be required. That's one dimension of it. That's the supply side. But on the demand side, see, a lot of clients, this is almost like the old situation of people rushed into digital and hardly 20% of the projects were really game changing. The same thing is happening in AI. Everybody is experimenting with AI. There is AI literacy generally available, but AI mastery has not happened. And I think the opportunity for all of us who are building IT companies in this landscape is to become masters at specific processes for AI and make that happen. So in that context, when you're talking about a different language, when you're giving an AI strategy as well as full end-to-end implementation, I think price will not be the issue. So I don't see that as, for companies going back into the double-digit growth that we talked about earlier, I think margins will also be excellent because these will be really different projects if we're talking about maybe a year and a half from now.
A very good point, Mr. Natarajan. But let's wind this conversation down with Moshe's final comment. Moshe, your view on the Indian companies, you still have companies like Persistent, Coforge. They are, Coforge, they are growing at a very, very good rate in comparison to the larger cap names. How would you position yourself, if you're looking to buy tech here in India?
A couple of things about growth. Even today, you have companies that are getting you those double-digit growth rates. They are focusing on product development, ER&D. These are very, very strong growth areas, but I would say they're very niche-y, and not every company can actually get the job done. Regarding the question on margins, I would say two things. One, in order for companies to really survive and thrive in a Gen AI kind of mode, if you will, they have to do two things. One, they have to decouple revenue growth from headcount growth. So they have to go for nonlinear growth. That's number one. Number two, they'll have to focus more on outcome-based contracts. So deviate from the old model, move to the new models, and in our view, that actually will get you margin expansion in your business. And some companies are starting to do that, but again, I think we're very, very early in this phase, if you will.
Okay, all right, gentlemen, very helpful conversation. Thank you for all the context. Basically, we need to watch the space closely and see how this AI transition plays out for Indian IT services. Thank you very much for joining in. Well, we take a break on that note. On the other side, we turn the dial to the oil and gas sector. Q2 earnings season is upon us, so what to expect from oil and gas companies? Prabal Sen of ICICI Securities will join in.
Welcome back. Well, as promised, it's time for our special segment, Quarter Tak, where we bring you expectations from each sector. Today, Sonal joins us to tell us what do we expect from the oil and gas space. Sonal, over to you.
Thank you so much for that. Well, we are expecting a mixed quarter in terms of earnings. But let's start with Reliance Industries. Already reported its numbers, and we did see that refining performance was quite strong. Company reported strong numbers despite some moderation that we saw in the petrochemicals margins. But moving on to oil marketing companies, that's BPCL, HPCL and IOCL, they are set to report robust year-on-year growth thanks to elevated marketing margins this time around. However, those margins have softened on a quarter-on-quarter basis. On a YOY basis, diesel margins jumped 39%, ATF or the aviation turbine fuel margins were up 22%, and LPG margins, they rose 4%. Even though LPG operations continue to post losses, those losses have nearly halved sequentially, coming down to about 4,000 crore rupees. Overall, EBITDA is expected to surge sharply, 92% for BPCL, 127% for HPCL, 191% for IOCL. That is the analyst expectations. But let's talk about some gas utilities. The other hand, GAIL could see a weak quarter. Lower transmission and trading volumes are likely to weigh on performance, with EBITDA expected to decline 26% on a YY basis. That's on the back of a 9% drop in transmission volumes and weaker trading spreads as well. For the city gas distributors or CGDs, margins are under pressure due to higher feedstock costs. Mahanagar Gas, remember, took a price hike in the second quarter to partially offset those input cost increases. In terms of volumes, IGL and MGL are expected to post 5% growth and 9% YOY growth respectively. But when it comes to profitability, EBITDA could be down 9% for IGL, 10% for MGL and 9% for Gujarat Gas this time around. So overall, while refiners and OMCs are set to deliver strong earnings, the gas utilities may continue to face near-term challenges due to rising input costs and softening demand. But of course, watching out for impact because of the sanctions that have come by on Russian oil from the US.
Okay. All right, Sonal, thank you very much for that. So let's discuss this with Prabal Sen, who tracks the energy space very closely at ICICI Securities. Prabal, thanks so much for joining in. We'll come to earnings in just a bit, but let's address the hot news in the room in the last 24 hours, these sanctions and what they mean for oil marketing companies. So let's start with the OMCs first up. Just run us through your expectations, how you were expecting refining margins to shape up in Q2, and more importantly, what happens now if oil remains elevated and some of these refineries can't source Russian crude?
To answer your first question first, I think expectations are similar to what Sonal discussed earlier. Refining margins have been fairly healthy and are expected to increase by anywhere between $2 to $2.50 on an average for the OMCs on a sequential basis. Year on year, the number will be slightly higher because of a low base, and inventory is also expected to be favorable a little bit to that extent. And therefore, numbers for Q2 look fairly healthy on a YY basis. As far as the second part is concerned, what happens with respect to Russian crude? There have been multiple sanctions, there have been multiple moves by the EU in any case over the last year or so, which have not really had a material impact. I mean, they've increased the effective cost of procuring Russian crude, but the flows have not really stopped. I think the fear really is that if the flow itself gets stopped and you have to sort of shop around for alternative sources of crude, it would essentially increase the cost of procurement. Simple as that. Today, you have 25 to 30% of crude still coming through in our overall sourcing mix from Russia. And if you have to replace that with alternate sources, you lose out not only on the discount that you're getting on Russian, which is around $2 to $2.50, depending on who you ask, but you probably may have to also pay slightly higher to procure crude at short notice. So assuming that there's a $3 hit that you take on 30% of crude, simplistically speaking, it causes a $0.9 a barrel hit on your GRMs. What can offset it is the fact that diesel and ATF and gasoline spreads have actually improved quite a bit, at least in the beginning of this quarter. Even though benchmark margins remain subdued because of other products, for Indian refiners, the strength in diesel and ATF and gasoline is actually a fairly positive development if it sustains. So we'll really have to see and weigh. In terms of earnings impact, every $0.50 reduction in GRMs from whatever base you're looking at reduces your consolidated EPS by anywhere between 4.5% to 7.5% for the OMCs. For Reliance, the impact, while in absolute terms may be higher, but because of the consolidated nature, the impact would be in low single digits in terms of consolidated EBITDA.
Those are lots and lots of numbers, very detailed, and really gives us good context. Let me just repeat that for the benefit of our viewers. You're saying that a shift in the sourcing mix, if we say that we drop down to zero Russian crude and then move to alternate sources, then because we lose on the discount and the transportation cost goes up, so purely on the back of that, the hit could be $9, right?
No,
0.9.
Sorry, it's $0.9.
$0.9. Okay, $0.9. Okay, yeah, that's what I was wondering. 9, okay, that sounded like huge. $0.9. But you're saying that it should be more than offset by diesel and the rest of the crack. So net second half, what are you expecting on GRMs? Based on the assumption that we go down to almost nil Russian crude.
Yeah, I think as I said, it probably would remain, similar to current trends. As I said, one thing would offset the other. So we continue to build in reasonably healthy margins. But Reliance doesn't report GRMs explicitly, but the range is anywhere between $9 to $10 is what we are working with at this point of time. We see no reason to change it. And for OMCs, it is in the range of around $6 to $8. That is something that we will continue to live with at this point of time.
All right. Hi, Prabal. Always good to hear your thoughts. What about the city gas distribution companies? What are the expectations from those names? And what do you like from the pack?
We continue to like MGL. I really think that the volume growth coming through in a fairly strong way, with the margins continuing to be, let's say, while they're not going to hit your record levels that they hit a couple of years ago, of 12, 13 rupees of gross margins. Or EBITDA margins rather, they are now looking at a more moderate margin environment. But the volume growth coming through, I think, continues to be a surprise for us, and the sustenance of that volume growth should lead to our performance. IGL also looks healthy to us right now. I think they are achieving slightly better volume growth, and with the moves that are happening on the zonal tariffs, as well as the news coming through of VAT reduction, their cost of gas should actually continue to reduce over the next few quarters. So MGL, IGL is the preferred pecking order right now.
And on Reliance itself, on the oil and gas side, what would the expectations be for the second half?
So I think the EBITDA run rate, should probably continue to be in the around 14,500 to 15,000 run rate. Again, there are several countervailing forces. Petchem margins at the margin are, a bit of a mixed bag, but they have improved a little bit if I look at trends versus last year. Refining margins, as I said, continue to look strong. But again, now with this crude cost coming through, you could probably have a little bit of a dampener for the second half. So on the whole, for the full year, we continue to believe somewhere between 55 to 60,000 crore of EBITDA is eminently doable for the OTC segment. And, of course, on an overall basis, we continue to believe that earnings growth will, on a consolidated basis for Reliance, should be in the range of around 13 to 14% for this year.
And GAIL, Prabal, what to watch out for this quarter?
I think volume trends have been a little bit mixed. Power demand continues to be subdued, and therefore, overall demand has seen a little bit of a slowdown. But I think the guidance that has been given now of around 5 to 7 MMSCMD growth over last year, I think that should continue to be there. I think what is more of an important monitorable is what happens to trading margins, given the way that they have behaved. I think the trend has been a little bit more muted compared to last year in terms of the quarterly run rate that has come down to somewhere around 1,400 crore a quarter. And I think that remains the key driver for earnings. And of course, as and when the tariff order comes in, that will remain the big trigger for this year, really, in terms of how the stock behaves.
All right, Prabal, thanks a lot for joining in, giving us your thoughts. I think you were getting a couple of calls. The kids have their holiday season. I'm not sure whether it was them. Thanks a lot for joining in and giving us your quick input. But let's focus on one of the stocks of the morning. The big breaking news that came in earlier today is that Federal Bank is going to get a big 6,000 crore rupee fund infusion via warrants. Gaurav joins us to break it down for us. Gaurav?
Well, yes, a big news coming in. Today was the board meeting of Federal Bank, and they have now approved investment by Blackstone of up to 6,200 crores in Federal Bank for around 9.99% stake. Now, remember, they are going to issue around 27.2 lakh shares, 2 lakh convertible warrants at a price of 227 rupees per piece. When we look at the total deal, now the warrant shall be exercised in the next 18 months, and the upfront cost that they will be paying is at 25% of the amount, which will be somewhere equivalent to around 12 to 1,300 crores is what we are estimating. Apart from that, they also have an approval to grant one nominated non-executive director. So that is also something that we will be watching out for. And what is also a key thing to watch out for is that how they are going to infuse and invest these funds. And the reason being that when we look at the CRAR ratio, the currently Federal Bank's CET ratio and CRAR ratio are well within the guided range. CRAR stands at around 15.71, CET stands at around 14.37, which is well above what is guided by regulators. So definitely one thing that we will be watching out on is that how this investment will be utilized going ahead. Remember, they also have their Federal 4.0, where Mr. Manian said that the breakthrough phase strategy is something that they're working on. So definitely we will be watching out on that. But as of now, a big news and a big investment coming up in Federal Bank.
Thank you very much for that. And the other big story is what's happening in defense. And Upasana joins in with the details. Upasana.
Well, certainly. Now, DAC clears proposals worth 79,000 crores. Now, let us look at the key beneficiaries on the back of this, according to Elara Securities. Under Indian Army, Nag missile system, Bharat Dynamics in focus, as the estimated order value here is around 2,000 crores. Next is ground-based mobile systems. Bharat Electronics will be in focus in this segment. Now, coming to Indian Navy's land platform docks, under this, stocks like MDL, Cochin Shipyard, GRSE will be in focus, and the order size estimates here are as high as 60,000 crores. Now, naval surface gun, BHEL and GRSE in focus on the back of this. And coming to advanced lightweight torpedoes, Bharat Dynamics again in focus on the back of this, and the order size estimated here is 500 to 1,000 crores. And lastly, coming to electro-optical infrared search and tracking systems, BEL in focus. So all in all these stocks remain on our radar today on the back of this.
Thank you very much for that. There you have Midwest has listed with a mild 100 rupee premium today, and that's an uptick of close to about 8-9%. Chandan Taparia is now joining in. He's the head of derivatives and technical wealth management, Motilal Oswal Financial Services. Chandan, another flat day. Yesterday, we paired all our gains to close flat. And today also it's quiet, though there is some activity at the mid-cap index level. What have you made of the action so far, and what would the calls be for the day?
Good morning. Thanks for having me. So on last trading session, Nifty headed to 26,100 marks. However, we witnessed some profit booking at higher levels, but overall trend remains buy on decline. Even for the day, it took support near 25,850 marks, but base is shifting higher. We believe that till Nifty holds about 25,550, buy on decline could continue, and somehow the index has potential to head towards 26,000 and 26,277. There is a lifetime high for the index. So we'll continue to be with bullish stance, with buy on decline stance. However, it might remain consolidative for next few hours, but I think next leg of rally cannot be ruled out given the data which we have. Now talking about Bank Nifty index, Bank Nifty has been outperforming the broader market. However, it has been consolidating in a range, but till it holds above 57,500, overall up move could continue towards 58,500 to 58,750 kind of level. So both the indices are looking positive, looking for buy on decline stance. If I look at the data setup, India VIX is at comfortable levels. Put call ratio has been holding well, and FI's long short ratio has recovered well in last 4 to 5 days. So I remain looking for buy on decline stance in the market. Now talking about trading ideas, first trade is going to be on buy on NALCO, National Aluminium. We have seen that most of the metal counters are doing well, and NALCO has given a consolidation breakout on the daily and the weekly chart. In fact, the stock is now trading at multiples month high level. We have seen build-up of long position led by put writing, so one can buy NALCO with a stop loss of 232, and this stock can head towards 251 kind of level. Second trading idea, that is buy on Chola Finance, positive on the BFSI segment, and Chola Finance is one of the strongest name. In fact, we have seen the build-up of long position. The stock is now entering towards the new lifetime high territory. So with support of 1670, one can buy for an upside target towards 1770. And last trading idea, that is buy on BL, that is from the defense spec, and I believe selective defense counter could do well. And here we have seen a consolidation breakout of last 25 days. Stock is holding well above its key moving averages and holding well above its rising trend line. So one can buy BL with support of 412, and this counter can head towards 444 marks.
Thank you very much for that. Get into a break. On the other side, Manisha Gupta will join in to talk about commodities. Stay tuned. Welcome back. It's time now to talk commodities. Manisha is now joining in and she's got her eye on base metals. Manisha, what's happening here?
Well, it looks like money flowing into this segment finally, and we're looking at strong gains when you look at the last 1 week or last 1 month as well. The major trigger clearly has been the plenum meeting in China going on, where they will set policy for the next 4 years, and expectation that there could be some stimulus coming in for infrastructure, real estate, etc. So the metal price is really hoping to see something there. I'll start with copper prices, which have seen a 2% of gains in the overnight market, and with that, we are up 2.5% for the week as well. For copper, it has been series of supply disruptions clearly coming in. If you look at the news coming in from Dominican Republic, there are nearly 80 miners trapped due to partial collapse of the mine therein. That is number one. Second is the halted activity in Indonesia's massive Grasberg mine. That is two. Third is disruption also coming in for the Codelco's LT and Tenetine mine underground. And then, of course, there are concerns coming in from various other mines in Chile as well. So wherever that you look, when it comes to major producing countries, there is something or the other happening, and that is supporting copper prices trading well above that $10,000 a ton mark at this point in time. But the major gains in the last couple of sessions clearly have come in for aluminum, up 2% overnight, and that brings us to 8% of gains in last 1 month when it comes to aluminum. Here as well, it is about the supply concerns. Remember, China has capped the output to around 45 million tons. That is exactly what they did last year as well. So there is those curbs in production continuing there. And then Iceland key refineries are also facing electrical issues. That is the reason we've seen gains onto that one. The markets also are looking at Alcoa shutting in their Kwinana refinery in Australia. And when you look at the LME stocks in aluminum, they have declined by nearly 25% in this year, just about at 484,000 tons is where they stand. I also want to talk about zinc because we've seen good gains into this one as well. So copper, aluminum, and then zinc. Prices have gained up by 2.5% in the last 1 week, and we are trading above $3,000 a ton onto this one as well. For zinc also, while the mining zinc is available enough, it is the refined zinc which is looking at some concerns. There are persistent bottlenecks among smelting operations in Japan, in Kazakhstan, that has been leading the prices on the higher side. The refined zinc production is expected to decline nearly 2% in this year, while the mined zinc could gain up by 6.3%. So exactly as I said, there's no shortage of the core zinc here, but the refined zinc, which is the usable zinc, is not enough available. Also, when you look at the LME stocks, we've seen very sharp decline onto that one as well. 37,000 tons is where we stand right now. Vis-a-vis 230,000 tons is how we started this year on. So clearly, every fundamental factor that you're looking at in the international markets is supportive of metals at this point in time. What the street will also want to watch out for in the coming days is the US and China trade conversation that is slated in South Korea in the next week there. And then it is also about the US consumer inflation data in the US markets that is expected today. So between these two and, of course, the China plenum meeting, the markets are anticipating that we are looking at bullish cues coming in for metals.
Thank you very much for that. Slip into a break. On the other side is our special segment, Indianomics. Lata will be in conversation with a whole host of experts on Diwali sales and whether it will fuel India's GDP.
Welcome to Indianomics. The government went all out to stimulate the economy ahead of the Navratri Diwali festival season, with the lower GST kicking in bang on the first day of Navratri. Did the stimulus work? First cut anecdotal data is as follows. Tata Motors said its sales in the 2025 festival season jumped by 33% to 1 lakh cars. Auto registration data, this one compiled by brokerage Nuvama, shows the two-wheeler sales grew 20% from Navratri to Diwali over previous year. Car sales grew 17% and LCVs grew by 23%. Electronics goods data compiler Counterpoint says smartphone sales grew 10% by volume and 18% by value. Vijay Sales told CNBC it saw 20% growth in consumer goods durables sales this year versus a growth of 10% in the last festive season. And finally, brokerage sources, various brokerage sources tell us that the top e-commerce sites, JioMart, BigBasket, Blinkit and Zepto saw 65% to a 200% growth in average daily users. Now, to give us their respective experience and data, I have with me Mr. B.C. Bhartia of Kaynes, or the Confederation of All India Traders. That is the brick and mortar traders. What I gave you was the app data. I also have Tarun Pathak of data aggregator company Counterpoint. I also have two economists, Abhishek Upadhyay of ISEC PD and Madhvi Arora of MK Global, to give us the top-down picture. Well, gentlemen and Madhvi, thank you very much indeed for your time. We were given to understand that electronic gadgets did very well. So, Tarun, I start with you. What numbers have you all been able to accumulate? How were the Navratri to Diwali sales compared to last year?
Thank you, Lata. So yes, very positive indicators. So the numbers are coming in, and I think we'll be coming up with the final set of numbers last week. But the early trends are indicating a very strong festive season this year, to a certain point that we are seeing a smartphone growth on volume 10% year on year, and by value even higher at 18%. So these are very positive numbers that are coming. In fact, the highest since 2020, when we have this COVID pent-up demand in 2020 festive season. And after that, this is the highest ever we have seen in a single festive season in the 5 years.
Okay. Any further data you can share on, say, specific consumer durables, non-cell phone, non-smartphone data?
Yes, we are seeing a very strong growth on TVs. In fact, 32-inch and above are growing in double digits year on year. We are seeing a very strong year on year across different consumer electronics, especially on laptops as well. In fact, the wearables also grew year on year. So overall, the positive sentiment, and this is coming across channel. It's not just the mainline versus online kind of split, but we are seeing this positive sentiments coming across different channels throughout India.
Okay. Well, let me come to the FMCG sales, the Kirana store sales. Mr. Bhartia, thank you very much for your time. Your press release very strongly said that if we thought e-commerce is taking away, or quick commerce is taking away market, that's not the case. You actually saw the reassertion of brick and mortar, sales. Can you give us some numbers first?
As per our research work, this Diwali, we can say, was a golden Diwali. In goods sector, we estimate sales 5.40 lakh crore. And in service sector, we estimate 65,000 crore rupees. This is a big number, and it is showing that consumers are coming back to market. We saw a lot of rush in all the market area. We call it as a golden Diwali. In addition to this, we see this Diwali. You see, across board, we saw good sales right from rural area, right to BMW. Everywhere we saw good number of sales. This is backed by increase just of reduction GST.
Okay. No, Mr. Bhartia, 1 minute. Your 5.4 lakh crore is very impressive. But can you tell us what was the rate of growth? I mean, last Diwali mein year on year aapka kitna tha? And this year on year, what was the rate of growth? Was it 20, 25, 15?
last Diwali, we estimated 4 to 5 lakh crores. This we see jump of about 25%.
Okay.
And the jump is in all sectors. As shown by you in your screen, you can see increase in all the sectors across the board. In addition to this, increase to the in the starters and
Got it. We have a problem with your audio, sir. We will fix it. But if you can bring out that table which Kate put out on textiles, apparel, sweets, namkeens. I must have contributed a great deal for sweets, namkeens for sure, and textiles in a very, very big way. Not sure of the others. Well, let me come to Madhvi now. Madhvi, you have a cohort of colleagues who are tracking individual companies and sectors. What is the macro picture you are getting? Are they telling you that this is a far better sale than previous years? I mean, just some comparisons.
So hi, Lata. I think there's been a very mixed trend across sectors if I look at the consumer behavior. Clearly, auto segment has been the biggest beneficiary of that. We've seen improvement across segments, be it a smaller segment of, say, of Maruti or Hero Motors, to the high-end premium cars as well. So that segment has actually seen across the board gains. But I think, beyond that, I'm not very sure whether I can really assume that this is basically a structural change per se, because see, last year the base effect was very different from what you have this year. Last year Navratris were largely in September and Diwali also was a little early. So this year the base effect also played out very well for certain companies in terms of their numbers. But beyond that, I'm not sure the discretionary space is actually showing across the board the same kind of enthusiasm. Clearly, as we were discussing, staples, for example, there's a lot of chaos in the near term because of GST like changes. Multiple MRP products are right now in the system. Distribution system and value chains are yet to be aligned. So we don't really know whether there's actually been an improvement in the staples consumption pattern. Of course, there's modern trade, which is also doing a lot of structural changes in the sector itself. Of course, QC has been over the roof. Fashion retail has done very, very well. And these segments, again, are actually, they were already doing very well pre-GST compared to other segments. Definitely, there's been some uptick in these segments, but I would still wait to understand whether this is, there is actually a trend beyond the festive excitement and the GST-led postponement of purchases that have played out in the recent 2 or 3 weeks.
Yeah, that is why when we were presenting the auto data, and that will come up for you, the auto sales guys, Nuvama, for instance, gave us 2 sets of data. One, from Ganesh Chaturthi to Diwali, and another from Dasera to Diwali. And clearly, the Dasera to Diwali sales is brilliant. It's gone through the roof, indicating that some slack, which was not, purchases not made from August 15th to 22nd because people were awaiting the lower GST, and that got made up. So that clearly indicates that August to October is not very spectacular. It's flat, sometimes even negative. But, September to October has been brilliant. Abhishek, I know you track, as a heat map, a lot of things. The rural incomes, for instance, have clearly remained higher. So it's not just the GST cut. It looks like the very good harvest and very low prices has also meant real incomes, especially in rural areas, remains very good. Can you, as an economist, take away a feeling that maybe GDP numbers have to be revised higher?
Lata, some of the data you mentioned on auto sales particularly is quite striking. That said, also it adds to the mixed but generally resilient data that you're seeing for Q2 otherwise also. So GST collections had started to pick up even before this demand surge happened. Also on the export side, we saw while exports to US were down 13%, overall exports held up well. So that augurs well for growth also. But I would be careful, like you alluded to also, in extrapolating this festive season demand-rated numbers going forward for various reasons. One, of course, big ticket consumer goods demand is easy to postpone as well as prepone, and number of tailwinds likely came together to prop up these numbers. So I'll wait whether this is a trend shift in demand or not. Second, I would rather prefer to look at how mass consumer items whether the price cut from GST is being transmitted there and how demand is evolving there, because those are items for recurrent consumption and could lead to recurrent increase in or a more persistent increase in consumer disposable income. I will wait for more color on that front. Third, what we don't know from these numbers is what is happening to the services demand side. So on that front, we know one big segment is real estate services, and the news flow there has been more mixed compared to the demand for goods that we have been discussing here. And finally, for me, from growth outlook standpoint, the big elephant in the room is really when high US tariffs are going to come down. So while news flow is positive, still not clear when that will happen. So I'll wait for that also. Okay. So not changing our growth numbers for now, but bias is to upgrade them once we get the Q2 numbers.
Okay, so you've answered the question I was going to ask you. Even if you have not upgraded the numbers, there is an upward bias to your numbers, is what you're saying.
Yes, so Q2 could be tracking maybe above 7%. We don't have government spending numbers yet for September, but could be tracking above 7%. So that would mean first half growth is closer to 7.5%. If these tariffs come down quickly, then second half growth could be 6.5 to 7% rather than 6 to 6.5.
Okay.
So inclination is to revise the numbers towards 7% from current 6.7% we have, but we wait for more data.
Okay, Mr. Bhartia, actually when I spoke to a lot of people who are not willing to come on air because, their results are not yet announced or whatever, they have no media policy. The retail store guys said that the first 6 months of the year, it was thanda. People weren't coming. Although there was a big income tax cut, which put 1 trillion rupees in our hands. One didn't see the impact, but there was something about the festive season and the GST cut that it triggered a flood of footfalls. Is that your experience as well? That the first 6 months were thanda, but some magic has definitely worked in the month of October. Mr. Bhartia.
Yeah, the consumers spend linked to future. If feel that future is bright, they come out.
I don't think we're not able to understand you, sir. There is an audio which we have to set right. Maybe we will put you on phone in a minute. Tarun, is that a feeling at all? That things were very quiet in the first 6 months and there was something magical post-October, a spring in the step. Did anyone tell you that? Do the numbers tell you that?
Yes, definitely. I think I fully agree to that. So when we do our consumer retail audits, especially on the electronics, we were seeing almost a single-digit decline in the first half in terms of consumer footfall, and most of the retailers were saying the same. But as we move into the second half of the year, there were positive sentiments that started somewhere late July and early August with the Independence Day sales and everything. And then the GST cuts happened. Everything was waiting for this festive season. So there was surely a pent-up demand. But the clear thing is retailers, the feedback, the collective feedback, what we are getting from the ground is not even there was more footfall, but also the incremental spending on electronics that has happened this year.
Okay.
So overall, that was a very positive for them, because compared to the last year, things were a little bit down and mainline were really struggling in terms of the offers and getting consumers into their stores and everything. So that started coming up, and that was a real positive decision in terms of electronics, especially smartphones.
Okay, that's good to hear. And as you gave a very big number, since 2020, when of course there was a burst of buying, we have not seen such a rate of growth. That is a very telling number. Madhvi, your cohorts, your colleagues, are any of them revising their earnings upward? And more specifically, the question like I asked Abhishek, are you in the front foot to have an upward revision of your GDP numbers? So both corporate earnings, are your colleagues doing anything, and your own macro number?
Yeah, so there's been clearly a shift towards some bias towards upgradation, but I don't think across the board they are doing it. As I said, auto sector has been the biggest beneficiary. Clearly, there's a case for revision on the upside. But I think for staples, they are still waiting and watching. As I said, there's a lot which is happening structurally as well as in terms of their value chain becoming much more synchronized. So I think they would wait at this point in time. And discretionary also, there's been a very mixed trend. I'm not finding excessive excitements in my analysts' view in terms of them really upgrading their thought process or their earnings at this point in time. But overall, of course, some sectors like auto, which are heavy sectors in terms of their market positioning, definitely would lead to overall upgradation in earnings for this for the Nifty. But that said, for the growth aspect, I agree with Abhishek. We would still wait and watch and understand how much is the trend coming out of this noise for us to really ascertain that consumerism actually making a massive more delayed retail therapy that we are seeing at this point in time. I'm not very sure whether the income effect has actually become so positive that we are going to be seeing this continue beyond the October-December period. There's also a base effect which is going to play out positively for October and the delayed purchases. So, of course, second quarter GDP, which will have a deflator effect, plus the third quarter, which will have the sequential gain, would augur very well for us. So maybe we will be seeing probably GDP growth actually coming out much higher than 6.5% that we are estimating for the year. But I'm still not sure whether we are in for a V-shaped recovery in India or whether it's going to be a U-shaped recovery. But one thing is for sure that consumerism, which was actually downtrending from the urban sector point of view, has at least found its trough, and it's now going to be gradually going up if things continue.
You guys have given me the big takeaway that I was looking for. That, when you entered the festival season, you did not expect the kind of bump up. Now, how much it will be is the next question I'm going to ask you after the break. How much of this can sustain? Or is this a one-time burst? That question will be after the break. Bazaar viewers, you will get to hear the whole show after market hours. For you, it will be time for Chartbusters.